$40 trillion. That's trillion with a T. I mean, it's a number so incomprehensibly massive that the human brain just kind of blinks and shuts down trying to process it, right? But I want you to picture it a little differently today. Imagine it as this heavy, silent shadow hanging over the American skyline. It's casting a cold, invisible weight over the streets below. Basically, it's a sprawling $40 trillion storm cloud that's been quietly gathering force while we were all looking the other way. You can't hear it, you can't actually touch it, but the pressure in the air is dropping. A real sense of dread is building before the very first drop of rain even falls.
Welcome to this explainer. Today, we aren't just glancing at abstract charts and graphs, we're stepping right inside the humming, invisible machinery of the global bond market. This is a story about a shifting world order, the actual cost of money, and the quiet cracking of a system we all assumed was virtually unbreakable. It's going to require our deep focus and a really serious look at the underlying mechanics shaping our immediate future.
Chapter 1. The $40 trillion shadow.
For a solid decade, the financial weather was perfectly clear. We lived in this era of absolute quiet complacency. Just imagine the calm waters of a massive global harbor where foreign governments and mega banks consumed US debt completely blindly. The sun was shining, the money was flowing, and it honestly felt like the music would never ever stop. But recently, a really subtle anomaly appeared in the system. Now, investors are whispering a terrifying question across tense, fluorescent-lit trading floors from Wall Street all the way to Tokyo. What if lending money to the United States isn't the safest bet in the world anymore? Think about it. 5 years ago, asking that question would have gotten you laughed straight out of a boardroom. Today, it's causing veteran traders to sweat through their collars and grip their coffee cups just a little bit tighter.
Chapter 2. The perfect machine cracks. To truly understand the gravity of that whisper, we've got to step inside the cold, unforgiving math of global finance. If you strip away all the political noise, you're left with a brilliantly simple machine that literally dictates how the United States government survives. Step 1. You give the government your money today. Step 2. The government promises to pay you a steady drip of interest. Step 3. Years later, it hands your original money back. For decades, I can tell you with absolute certainty, this machine ran flawlessly without a single hiccup. It was the absolute bedrock of global finance.
During that golden era of the world's reserve currency, the flow of capital was basically a deafening roar. Picture the sheer volume of money moving across oceans. You had Canadian pension funds securing their retirees' futures, Asian central banks stockpiling reserves, European insurance companies demanding absolute certainty in their portfolios. The entire global financial system revolved around taking dollars and recycling them straight back into US treasuries. And the absolute beauty of it was, the more these massive global buyers bought, the lower America's borrowing costs dropped. It was this beautiful, flawless, self-sustaining loop.
But here is the massive inciting incident of our story. The winds have abruptly shifted, and the era of virtually free money is over. The flows of capital have actually changed direction. We're seeing China reduce its massive holdings. Other nations are quietly sliding their chips toward alternative assets, diversifying heavily into things like gold. The guaranteed hungry buyers of the past are silently stepping back from the table. And they are doing it right at the exact moment that the United States is exploding its debt supply into the tens of trillions.
Chapter 3. The brutal math of gravity.
Basic economics is an absolute force of nature, and right now gravity is taking over. Supply is exploding, demand is dropping, and yields are violently climbing. Let's ground all this macroeconomic suspense into a feeling we can all actually understand. Picture a young family sitting at their kitchen table on a rainy Tuesday evening. The warm, isolating glow of the overhead light illuminates a stack of loan documents in front of them. They are looking at the exact same house they wanted a year ago with the exact same loan amount. But because the rate jumped from 2% to 7%, their monthly payment has completely skyrocketed. You can literally see the dread washing over their faces, that sinking realization that the American dream just got unimaginably heavier. Now, I want you to scale that young family's dread all the way up to the level of a global superpower. The United States government is sitting at that exact same metaphorical kitchen table. The old, incredibly cheap debt from the zero-interest era is maturing, it's expiring. And to pay it off, the government has to take out new loans, meaning they have to refinance it all at today's punishingly high interest rates. We are talking about rolling over trillions of dollars. The sheer scale of it is absolutely terrifying. Take a deep breath for a second and just let the weight of this reality sink in. America is increasingly borrowing money to pay interest on money it previously borrowed. That is a chilling sentence. Interest payments aren't just a standard line item in a spreadsheet anymore. They are now a compounding cycle.
They're feeding on themselves, fast becoming one of the absolute fastest growing and most dangerous expenses in the entire federal budget.
Chapter 4. Tremors in the floorboards.
You see, the bond market doesn't exist in a vacuum. It is the very foundation of the house we all live in. And right now, there are violent tremors in the floorboards. The shockwaves are spreading out from Washington and Wall Street, rattling the windows of literally every business and home. Because when the government pays more to borrow, a terrifying chain reaction begins. Mortgage rates spike, corporate borrowing costs jump up. The auto loan for your car gets significantly heavier. Student loans become a much tighter leash. Commercial real estate financing completely freezes up, and private credit and venture capital pull back. It's this tightening grip slowly choking the oxygen out of everyday consumers and massive global corporations alike.
Imagine the chaotic sounds of a modern trading floor during a live treasury auction. You hear the frantic clicking of mice, the intense, low hum of the servers. It is a high-stakes stress test happening in real time. On one side of the room, you have the stock market. It's optimistic, it's smiling, it's always willing to buy into a really good story about the future. But then you have the bond market. It's cold, it is deeply skeptical. Bonds do not care about your stories. Bonds do math. And right now, those blinking red numbers on the screens are aggressively stripping away all the optimism.
Because the thing about cold math is that it cannot be ignored forever. The official projections from the Congressional Budget Office are grim. We are looking at large deficits stretching out into the dark for years. Entitlement spending is growing, interest expenses are exploding, unstoppable debt growth. It is a slow-moving freight train of numbers, and it's fueling a very deep, gnawing anxiety in the bond market about the future stability of our entire economic engine.
Chapter 5. The Cost of Confidence.
Let's slow down for just a second here. America is absolutely not doomed. The country isn't packing up and leaving. The US still has the deepest, most incredibly dynamic capital markets on the entire planet. But something profound has died. That absolute, unquestioning trust we had during the zero-interest era, it's gone. When an investor buys a 30-year treasury bond today, it is a massive, terrifying leap of faith. They're essentially betting on 3 decades of inflation control, 3 decades of political stability, 3 decades of economic resilience. And right now, as investors stare out into that cloudy, highly uncertain future, they are demanding a much, much higher price to secure that confidence.
Which leads us to this massive realization. You see headlines every single day screaming about the future, but the absolute most important story of this decade is not artificial intelligence, it's not the wild, unpredictable swings of crypto, it is this quiet, invisible, humming market that determines the cost of money itself. It is the story that will dictate exactly what governments can afford, what businesses can actually build, and what everyday families can buy.
The days of unlimited cheap money are gone. We have permanently crossed a threshold. The era where you could just borrow without consequence, where the rest of the world endlessly swallowed the debt without ever asking the price, that world has faded to black. The entire global financial system is now waking up to the incredibly heavy reality of what comes next.
For generations, we literally never had to ask if the buyers would show up. They always did. But the real question right now isn't if the buyers exist. It's this: how much will they demand to keep buying? The answer to that question is going to echo through our economy, our politics, and our daily lives for decades to come. Thank you so much for joining me for this explainer. Keep your eyes open out there, and I'll catch you next time.